For much of 2023, the narrative around the Malaysian ringgit was overwhelmingly negative. It was frequently cited as one of Asia's most challenging currencies, hitting historic lows against the US dollar and its regional neighbor, the Singapore dollar. But currency markets have a way of delivering dramatic reversals. In 2025, the story has completely changed. The ringgit has staged what can only be described as a great reversal, emerging as one of the region's top-performing currencies. This isn't just a minor fluctuation. As someone who has spent 6 months in Malaysia focusing on capital flows and political stability, I can tell you that a currency movement of this scale is a clear indicator of deeper, more fundamental shifts. The question we must answer is critical for every investor and every Malaysian citizen. Is this rally merely a lucky consequence of external forces? Or is the Malaysian ringgit finally shedding its reputation and revealing itself to be Asia's most underrated currency? The evidence suggests the latter. My name is Rufus Brown, and in this video we will dive into the ringgit's rise. To understand the ringgit's strength, we first have to acknowledge the powerful external forces acting as tailwinds. But critically, these tailwinds are only lifting Malaysia because of its internal strength. The primary factor driving global capital flows has been the aggressive monetary policy of the U.S. Federal Reserve. When the Fed hikes rates, it widens the interest rate differential. It makes holding U.S. dollar assets, like Treasury bills, incredibly attractive. This sucked capital out of emerging markets like Malaysia. Now the opposite is happening. As U.S. inflation moderates, the market is aggressively pricing in the end of the hiking cycle and eventually rate cuts. The principle: when the expected yield on the U.S. dollar falls, capital chases better risk-adjusted returns elsewhere. The gap between U.S. and Malaysian bond yields narrows. The result? Foreign money flows back into the ringgit, creating demand and pushing its value up. This phenomenon is technically called mean reversion, but for Malaysia, it's also a vote of confidence. Malaysia is a net exporter of commodities, notably liquefied natural gas (LNG), crude petroleum, and palm oil. Despite global volatility, sustained high prices for these key exports provide a buffer of foreign currency earnings, which constantly strengthens Malaysia's current account balance. More importantly, Malaysia is a critical node in the global electronics and semiconductor supply chain. As we've discussed in our last video, the global technology market is experiencing a strong upcycle. Higher demand for semiconductors used in AI EVs and cloud computing translates directly into stronger export revenues and surplus dollars for Malaysia. This is a fundamental, structural support for the ringgit. So yes, the Fed and the commodity market are providing the opportunity. But it is the quality of Malaysian exports, the high-value electronics, and the necessary commodities that allows it to capture that opportunity effectively. The most compelling evidence for the ringgit being underrated lies in the domestic fundamentals, the things Malaysia can control. This is the internal strength that shielded the economy from the worst of the 2023 currency slump and is now fueling the comeback. Malaysia's economy has demonstrated remarkable resilience. In the most recent quarters, the country has delivered stronger than expected GDP figures, largely powered by robust domestic demand and a supportive labor market. Unlike many developed economies facing stagnation, Malaysian consumer spending remains strong. This creates a powerful positive feedback loop. Strong economic activity attracts investment, which further supports the currency. When I was studying political stability here, a major investor concern was always the national debt and fiscal trajectory. The current government has made fiscal consolidation a cornerstone of its policy. Targeted subsidies. The gradual shift away from blanket subsidies to more targeted assistance is a politically challenging but economically vital reform. It demonstrates a commitment to long-term fiscal sustainability and debt management. Progress in narrowing the budget deficit signals to rating agencies and bond investors that the country is serious about stabilizing its finances. This improves the perception of investment-grade quality. While the U.S. hiked aggressively, Bank Negara Malaysia maintained a prudent, steady hand, focusing on domestic growth and inflation management. This approach has avoided unnecessary shocks to the economy while ensuring that real interest rates remain supportive of growth. BNM's efforts to maintain market order and encourage the repatriation of foreign earnings by Malaysian corporate entities have been effective in boosting local ringgit liquidity and demand. A strong currency is a double-edged sword. To truly analyze the ringgit's implications, we must weigh the benefits, the sources of optimism against the potential challenges. A stronger ringgit makes imports cheaper. Since Malaysia imports a significant amount of food and manufacturing inputs, this is a powerful, non-monetary tool for dampening imported inflation. This is a direct benefit to consumers and businesses relying on foreign raw materials. Crucially, a stronger ringgit reduces the ringgit equivalent cost of servicing foreign-denominated government and corporate debt. This frees up capital for domestic investment and helps improve the country's balance sheet. A stable, appreciating currency is a sign of economic health and lower currency volatility risk. This acts as a powerful beacon for long-term foreign direct investment, FDI, particularly in high-growth sectors like digital economy and high-tech manufacturing. A stronger ringgit makes Malaysian goods more expensive overseas. This primarily affects low-value, price-sensitive exports. Malaysia's strength is increasingly in high-value-added electronics and specialized goods. For these items, quality, reliability, and place in the supply chain are more important than marginal price changes. It becomes more expensive for foreign tourists to visit and reduces the value of remittances sent home from Malaysian workers abroad. The key here is perspective. The current appreciation is driven by fundamentals, not speculation. This means the benefits of fiscal health, inflation moderation, and FDI attraction outweigh the risks to high value-added exports. It signals a move up the value chain. The question here is the Malaysian ringgit Asia's most underrated currency? My conclusion is a resounding yes. The great reversal of 2025 is not a market anomaly. It is the inevitable consequence of a resilient domestic economy, prudent financial management by BNM, and a strategic position in the new global supply chain order. The global environment is providing the wind, but it is the solid, structurally reforming Malaysian ship that is sailing forward. For too long, the ringgit was valued based on past risks. Today it is beginning to be valued on future strength. This is a story of stability, reform, and renewed confidence. It suggests that Malaysia is not just recovering but fundamentally re-anchoring its position as a key economic powerhouse in ASEAN. I'm Rufus Brown. Thank you for watching.